Hey there, everybody. Andrew Marlowe here, and welcome to Marlowe's Mortgage Minute, where we bring you all the tips and tricks in the mortgage and real estate worlds. Today, we're going to be talking about a crucial part of the purchase process, or purchase application, if you will, and that is your loan contingency. Understanding what a loan contingency is crucial for not only buyers but also for sellers to know what they're getting into as well. So let's dive right in. A loan contingency is a clause in a real estate purchase agreement that makes the sale contingent on the buyer obtaining financing. In simpler terms, it means a buyer has a specified time period where they can apply for a mortgage loan and get approval, and if they don't get approval during that time, or if they get denied during that time, they have the option to back out of the contract. Here's how the loan contingency works and why it's important. Number one, it's protection for the buyer. It gives the buyer a period of time where they have to go out and get financing or apply for financing, and the option to withdraw their offer and save their EMD if they can't secure that financing. The loan contingency protects the buyer to make sure they have enough time to go out and try to apply and obtain financing for the home. It allows them to back out of the deal if they can't secure financing with satisfactory terms such as interest rate, loan amount, or other loan conditions. Number two, it gives a timeline for loan approval. So typically, at least in Nevada, we have a section in the contract where you put how many days you want the loan contingency to be. So you know, the lender knows, the agent knows, everybody knows that during that time period, you want to get fully approved by underwriting. If you don't during that time, then you run the risk of losing your EMD. And that's what the whole purpose of the loan contingency is, to protect your EMD and protect yourself so that if you can't get financing, you don't lose out because you can't get financing. If the buyer's loan application gets denied during the specified time frame, the buyers can invoke the loan contingency and pull out of the deal without losing their earnest money deposit. They might be out for the appraisal costs and the inspection costs if those have already been completed, but they can get their EMD back and they don't get any other negative consequences of it. However, it is crucial for you to read and understand every part of the residential purchase agreement that you're signing, and make sure you know, your lender knows, your agent knows, you know the contingency dates, you know when you need things to be done by, and you have your team stick to the timeline. If you don't keep an eye on the timelines, you run the risk of losing your EMD, getting denied for the mortgage outside of the contingency, losing your EMD, and being out of place to live. And that's not something that anybody wants. Everybody wants to make it work. However, it is important to note that a loan contingency does not constitute or guarantee a loan approval. It is simply a time period agreed upon with you and the seller that you have to go get approval on a mortgage. And if you don't get approval during that time period, you will get your EMD back for whatever. If you don't get approved for whatever reason, you can get your EMD back from the seller and they can't keep it. Now, on the flip side, if it's, say your loan contingency is 20 days and on day 21 you get denied, that seller has the legal right to keep the EMD if you pull out of that contract. Thoroughly understanding your contract and your purchase agreement and all the different terms on there, as well as the contingencies on there, is one of the most important reasons that you want to have a great team behind you. You want to have a great agent, you want to have a great lender, everybody on the same page working together to make sure your funds are secured, you're safe, your EMD is safe, everything on the buyer side is safe, and everything on the seller side is safe, and make sure everybody's working together to get to the same common goal of getting that house sold. So to sum it all up, a loan contingency is a period of time during the contract period where you have the right to back out if you can't get approval for a mortgage. But remember, it's always important to review your contract fully and understand the terms and conditions of your specific contract, because it does change deal to deal. No two deals are the same, so you want to keep an eye on that. Take a look, know what's in there, know what you're getting into, and know what your outs are. That's all we got for today on Marlowe's Mortgage Minute. Thank you for watching. Please like, share, and subscribe. Send it to anybody who you think might find some value in it. And I hope you guys have a great day. Thank you.